Good morning, everybody. And for those of you in New Zealand, good afternoon. Welcome to our Premium Asia Income Fund update, which we've sort of structured in light of what's recently been happening in our fixed income markets. My name is Jonathan Wu. I'm one of the executive directors and chief investment specialists for Premium Asia Funds Management. I'm very happy to have Gordon Ip, who's the co-chief investment officer of the fixed income team at Value Partners. Today, the purpose of today is effectively to sort of walk through some key questions that we've had from investors, as well as ourselves. Just to declare my family's interest, we've got about $4.5 million exposure in the Premium Asia Income Fund. And so some of these questions are also stemming from our own family office and been asking Gordon around how the portfolio is constructed and sort of where to from here. You will have noted that the path of the fixed income fund and its unit price has largely been also reflective of how the equities market has performed post the reopening in China, where we had a very quick surge in the sentiment, and then it sort of came back down reasonably flat. And so the stimulus measures, in a certain way, we're still waiting for. There have been a few that have happened since the 31st of August, and I might ask about that to Gordon shortly. But we don't have a lot of slides today, and we've got a couple of key questions. For those of you on the line, this is going to be recorded. You will see in your GoToWebinar panels that there is a question box that you can ask questions, and we'll address them. We've left ample time to cover those off today. For those of you who are not licensed financial advisors, just a reminder that today's information is general in nature only. It does not constitute advice or recommendation to buy or sell our products. If you do require financial advice, please go to ASIC or the FMA's website in New Zealand to find an authorized financial advisor to give you further advice on this product or the market generally. So Gordon, thanks very much for your time. I just thought, just sort of to kick things off, I mean, given the great purge in the Chinese property market over the last 2 years, I mean, in your mind, what is the role of Chinese property developer bonds in our portfolio, short, medium, and long term?
Hi, thank you, Jonathan, and good afternoon or good morning for everyone in New Zealand and Australia. So thank you for having me today. So for the China property, I have always said that it is a very important sector for China. Actually, it is a very important sector for a lot of countries as well, right? So for the whole history of time, we know the healthiness of the property sector. It has a very, very deep implication to the overall economy, right? Just simply common sense, if one buys a house in anywhere, the associated kind of spending, for example, you buy a new car, you need new furniture, construction worker needs cement and steel pipe, all these things to build a house, right? So the associated spending associated with this property sector in everywhere has a huge implication to the overall economy. Okay. So to answer your question, how important it is, it will mean that the property sector will remain a key sector for China, especially when you look at how China calculates the GDP. I would say maybe 25 to maybe even 1/3 of that component, the GDP component, is actually coming from property sector related, right? If you count the associated spending together, it's even more. So although we have some really, really challenging time for property sector in China, I think that it will still remain a very important sector to look at. The good thing is, after this great purge, a lot of the so-called weaker hands or developer that shouldn't exist at all, meaning those are growing by employing excessive leverage. Those players has actually completely gone. They are purged from the system. What we left behind is a much more healthy, even a stronger developer, right? We have a composition of state-owned developers, and we have a select set of very, very good and well-managed private-owned developer at the end of the day. So I would say, although the past 36 months has been really, really difficult, and we have seen lots of negative headlines from this sector, I believe that we, at the end of the day, we will see a much more healthy sector, as well as in terms of investing. Arguably speaking, investor can once again sleep better buying property bond, because what's left behind is those are the stronger and healthier players in the field.
Do you think, Gordon? I mean, and we've had a couple of chats about this recently on Country Garden, right? And Country Garden is arguably, in our view, one of the best run property developers, and even they recently sort of got into trouble and risks not being able to pay the interest, but ultimately they negotiated with bondholders in the last week to roll it over till, I think it was 2026. I mean, how does that change your viewpoint? You have something so solid still deemed to be rather risky. I mean, then everybody else technically is on the line as well, right?
Yeah, for Country Garden is a lot of people, they try to compare the case in Country Garden versus that of Evergrande, right? No, these two companies, they are both big. Country Garden is arguably bigger than Evergrande as well in terms of contract sales, right? And as you mentioned, Country Garden has been the darling of investor because they really have been the poster boy, the child poster boy for the entire industry. They are the good boy in front of the government's eyes, right? So those are the very well disciplined, very well managed company. And in terms of leverage, they actually are reasonable. Right? They are not like really leveraged up like Evergrande did. But one thing is, I have always been telling investors, when you look at the credit, all right, don't just plainly look at the leverage, right? For example, again, using Evergrande as an example, they leverage up through the roof, but yet they was able to operate with no problem for many years, right? Obviously, Country Garden as well, but leverage does not necessarily kill a company, right? If you can keep the ball rolling, they can keep borrowing and refinancing through the market or through some other means, they can keep this game going forever, right? However, liquidity situation, as we see cases back in Lehman Brothers, right? For example, if an issuer even own the market or own anyone a single dollar, they can declare bankrupt, right? Not necessarily they are leveraging a lot, but it's just the liquidity, that bottleneck, basically cause a lot of company, into trouble. And in Country Garden, in this case, it's not really a leverage problem; it's a liquidity management, where basically, as you can understand, a lot of the refinance channel through the bond market, through the loan market, and also the contract sale is hitting bottom. It's really hard for even the strongest company to manage that kind of liquidity profile. When your CFO a couple of years ago, when they do the financial modeling and also liquidity projection, they don't anticipate this kind of situation to happen, right? So, but luckily for Country Garden right now, I'm happy to report that they actually pay the coupon, and they have actually managed to extend the maturity of their onshore bond. Okay, what's left behind is the maturity of a convertible bond in December, as well as a straight bond in January. So we will have to see what happens. I mean, if the liquidity situation remains the same, I believe Country Garden in this case will likely have to sort of extend the maturity of the existing bond. I'm not talking about a full-blown sort of debt restructuring exercise. I'm just talking about a simple, very simple maturity extension by, let's say, 1 or 2 years, and then buy time.
Okay. So the yield to maturity of the portfolio ending August is now 17%. I mean, what is the upside potential of the portfolio from this point, and how is it reflected in the maturity profile of the fund? Because what everyone can see on screen at the moment is that we've split out the maturity profile of the entire portfolio from basically you see that, to read from left to right, you see that less than 10% of the portfolio is going to mature in under 6 months, and then so on and so forth, with the majority of the portfolio being about 35% sort of maturing in under 3 years. So, Gordon, how does that look to you? Have you brought in the maturity of the portfolio in recent years, and sort of what's your thinking around that, and what's your intentions going forward?
I mean, for investors who have long been investing in this fund, you can notice that our fund has always been running a relatively short duration, somewhere around sort of 2.5 to 3 years, or specifically 2 years to 3 years kind of duration. So in terms of years to maturity, it's slightly longer, maybe 3 to 4 years, right? Just for the entire life of this fund. That's one reason. That's two reasons actually. One is basically the structure of the market. For Asian credit bond, most of them are at new issue, and they are usually 5 years in maturity. So that works out to, depends on the interest rate, sort of like 2.5 to 3 year duration, right? And also, the other reason is that we deliberately, for most of the time, we like to choose shorter bond because we understand that we invest in credit, and in particular, we have a fair portion of our portfolio in the high yield credit, basically the below investment grade credit, which arguably, if you compare the investment grade, high yield credit arguably offer a little less visibility and transparency, right? So in order for us to manage that credit exposure, owning shorter credit bond is a way for us to mitigate that sort of credit duration, right? Because the shorter time from now, that means I have better visibility on the future of the credit fundamental of an issuer. So the combination of these two factors basically result in what the portfolio maturity profile that everybody see on the screen is that a lot of them, they're really short. On average, we're just talking about 3.5 years to maturity, with a duration overall 2.5 years.
Just to remind everyone as well, Gordon, that fundamentally this portfolio, the risk is not duration; it's actually credit risk, right? Just because because the bonds are all fixed rate.
Yeah, absolutely. I mean, you just looking at the credit spread of the entire portfolio, you will notice that credit spread is actually quite thick, right? So when you look at duration of 2.5 years, I myself, I interpret it more as a credit duration than interest rate duration. So investors investing in this fund, they need to be reminded they are investing in a fund that primarily are investing in credit. This portfolio or this fund, they are not so much sensitive to interest rate change, simply because of one, short duration. Second is the credit spread is so thick that it could absorb a lot of initial interest rate shock.
This chart that I put up here, Gordon, what is this sort of telling us in regards to average price versus maturity?
Yeah, I mean, this chart actually tells a lot, right? So, Jonathan, you mentioned that our portfolio is like sort of high teens to 20% yield to maturity, right? So, how we interpret this yield to maturity of around almost 20%? I think let's look at how we arrive at 20% maturity. First of all, is that obviously is the rising interest rate will have some impact, not more, some impact to the overall portfolio where everything discounted at a higher rate, right? Most importantly is that our position in China, in particular China property, that has, as I mentioned, we have been struggling through a lot of difficult time for China property. As China property bonds, the price of China property bonds comes down, yield goes up. So what we see here is that we broke down the entire portfolio issue by issue and bucketed every 6 months for the entire portfolio, right? So as you can see that for the second half of from the remaining of 2023, the bonds within this bucket right now with an average price of 96 cents on the dollar. Okay, so if everything goes back at par during the second half of 2023, that means from right now we have 4 points of upside, and you can interpret this bucket by bucket, right? The summation or the overall, all in, if you add up all these number on the orange part of this chart, and then divided by the portfolio NAV, you can roughly work around. That's how we get the sort of high teens to 20% yield to maturity.
Does a 17 to 20% yield to maturity in your eyes, is that a broadly distressed portfolio or not really?
No, these are actually, this is a good question. When I prepared this chart, I deliberately took out all the so-called distress or bond that are really having a credit event, right? And those are the bonds that may be trading at $10 or $20 or even $5, right? But I can assure you that those portions actually account for really small portion of the portfolio. It's way less than 5%. Right?
Yeah, it's way less than
under 5%. Maybe 1 or 2%, something like that, right?
Yeah.
So so that means whatever upside you see on this screen, exclude those positions. Now, if any money coming back from those excluded position, is basically addition to what the number you see here.
Yep.
And the high teen and 20% that people see on their fact sheet also exclude those bonds that I mentioned before.
Yeah. Just a reflection point around COVID. I mean, it's broadly now in the background, and we sort of, life has moved on. Has COVID or any events that related to COVID made your team scrutinize or the way you look at company financials differently? And as a result of that, has that led you to avoid anything specifically?
That's another very good question, Jonathan. Yeah, I mean, COVID has impacted a lot of people in a lot of different ways. It impacts how we conduct due diligence and also how we look at the market and also analyze issue as well, right? For particular, so let me just use China property as another example. During COVID, as I mentioned, leverage does not necessarily kill a company, okay? But liquidity bottleneck definitely will do, right? And this is especially true during COVID and also the current downturn, is that instead of in the old days, we can often look at the credit worthiness of an issuer just by looking at how leveraged they are. So, for example, we look at the debt to EBITDA, we look at the short-term to cash ratio, all that stuff, right? But during this difficult time, it's really important for the manager to really sort of have a deep dive look on the underlying fundamental, in particular the liquidity profile. So with that, we actually scrutinize every single bond maturity and try to match it against with corresponding availability of money from the issuer. For example, how much of cash, right? Now, if you look at the cash level, it's even you need to do much more work. You cannot just look at the overall cash the company has. You really have to drill down to individual operating company to see where the cash is actually seated, because if the bond is issued by the holding company cash basically come from dividend upstream from the operating company, right? So even though you have, let's say, $100 of cash on balance sheet, it does not tell you, because this $100 can be distributed everywhere within the group, right? You need to look at the actual money and also rank the obligation and cash seniority in order to come up with a very accurate estimate of sort of real or free cash that the issuer can use to repay their debt obligation. So this is some of the things that we actually have stepped up a lot during the past 36 months in terms of how we look at all issuer, in particular Chinese developers.
I mean, when you look at the company's debt, ultimately you look at the bank loans and then you're looking at the bonds. I mean, has there been any loosening from your viewpoint around banks being more open to rolling over the bank loans to these corporates, or is it pretty much as tight as what's reflected in the bond market?
To be very honest, overall, not much, right? Even though they have been saying it, and the government and the Chinese government encourage all these banks to lend to developers. But if you're a banker, right? If you're a banker, you have to look at your own book as well, and you cannot just say randomly making loans for anyone, right? So I think overall is, but basically, the bankers are still very, very selective to make loans, right? Those the established and strong player with performing track record, those are still getting bank line. But a lot of the sort of smaller player with very little business scale, operation scale, those continue to struggle. So it's pretty polarized.
Sort of just going back to property, I guess. So you've made an active decision, and this is going back to our active management strategy. We've structurally decreased our exposure to property, and more specifically Chinese property, since August 2019. So that was months before COVID, or anyone had even heard about COVID. Can you sort of walk us through that journey as to why you did it? What was the thinking behind it? Because that's obviously dropped, and then sort of at the back end of 21, it increased, and it decreased again in 22, increased again at the beginning of 23, and it's also come off again, and in as it were it stands now. Can you walk us through that journey, and what have you seen through that journey?
Yeah, as you can see from this chart, right? So over the history of the fund, the highest allocation to property is like almost 80%, right? That was really the bull market, right? In the old days, where everybody just want more property, right? To keep them happy, especially in the background that back then interest rate is still really, really low, and property bonds actually was very, very yieldy at that point. And government intervention hasn't come yet, right? So everything is, jolly good back then. That's why everybody hold a lot of property, 80%. And we have been, to be very honest, this has, good correlation with the performance of our fund as well, right? So up to like around at the same time, the performance is almost like a straight line, right? So we take full advantage of the bull market of the Chinese property. So from that on, we basically, when government interventions start coming in, we start to take profit or cutting exposure to Chinese property from then on. And in 2021, and also the better part of late 22 and early 23, we also increased our exposure because of one, the valuation was just too cheap not to own. Second is that back then, at two different points of time, there was some sort of more positive or supportive government announcement to support the property sector, right? And obviously, we don't just listen to the government. We want to see evidence that any rally is sustainable, right? So, for example, the latest reduction in exposure is that what we see is that from the end of 2022 up to Q1, that huge performance and also increase of allocation was basically based on the government say, okay, I'm here to help and continue to support it, right? And I'm going to take my hands off to the sector, right? So market take it quite happily, and then and all the bond price rose a lot at that time. And we also we pre-position, so we take the full advantage of that cycle. But starting in Q2, because as I mentioned, the government can say one thing, but what we need is the follow through a real action. And starting in Q2, we haven't seen any concrete measure from the government, so we kind of disappointed, and therefore we cut, right? Same as the most recent reduction is that we continue to believe that the government is they talk more than do more, right? So therefore we also want to reduce exposure. And also when we reduce this exposure, we don't just cut proportionally. We also took the chance to really study the individual name within that sector to really try to, if we eliminate the relatively weaker hands or company that their fundamental has changed since last time we have the position. So right now, as you can see, we are basically trending at the lowest point of allocation for China property through the life of the fund.
I mean, in the last week order, there's been some change in policy. Let's call it, for one better word, it is still a form of stimulus with regards to changing your first residence, right? So previously, you bought your first property, you needed a 35% deposit. This is for main cities, by the way, that they've done this. If you were then to sell your first property and then buy a second property, but you really are just replacing your first property, you had to pay 60% deposit. So on the 31st of August, the central government announced testing in 4 major cities, which is Beijing, Shanghai, Shenzhen, and
Guangzhou.
They said that if you are simply replacing your property, we'll still take that as your first property, so you just have to come up with 35% upfront as opposed to 60. Does that change your view on real estate overall, Gordon? Or real estate developer bonds, because it's a very different viewpoint of what a real estate versus real estate developer bonds.
The government actually has done 2 things. One is what you mentioned is the change in the amount of down payment, right? And the second thing, they actually lower mortgage rates as well, right? Something like 40 basis point, right? But I think within these 2, the first one, if any help at all, will be a little more effective than just simply lowering the mortgage rate. If you lower the mortgage rate, I think maybe people be able to buy a better lunch, and that's all about it, right? The first one, lowering the mortgage rate, personally, I think it helps a little bit, but it's not a game changer to stem the trend, right? Because again, it's common sense, right? When people expectation that the market will continue to go down in the property price, and the economy is not performing the best, and people naturally make less income. This kind of situation is not easy to convince people to have a major spending like buying a property. There could be some help, basically the buying from the richest, but the general population, the impact I think will be quite muted.
Yeah. Okay. So, outside of property, I mean, where have you found? Oh, sorry. Before we move on to that, there's one piece of data that we've actually generated, and for those who are interested in the raw data of this, we're more than happy to provide it. And this sort of revolves around the fact that at a very macro level, because this fund doesn't have a formal benchmark, because it's very hard to find a formal benchmark for what we do, is that the investor experience is effectively just seeing the fund's unit price fall. Okay, and let's call a spade a spade. It's been disappointing. And so what I want to do is primarily a lot of the mark-to-market losses that were stemmed or reflected in the unit price of the portfolio is really around less to do with default itself, but more just the sentiment. And when you then overlay the way that we manage money, which is very active, and we will trade through the cycle, what we've mapped out here on the screen is over the last 3 years, up until the 24th of August this year, which is 2 weeks ago, this maps out every position we got in and out of for the fund. And what is reflecting is the further loss prevented by what we did. Okay. So if I use the far left, which is the Agile bond, basically because we sold it where we did between this period, right? Because we're just looking at this great purge period, we saved investors $800,000 worth of further losses. So if we had continued to hold it, what is the mark-to-market value of an Agile bond on the 24th of August? Okay. And then same with Kaiser, which is the largest one there that you see around the middle of the chart. The Kaiser bond, because we sold, we saved investors a further $1.2 million loss. Now, the ones that are below the line are the opposite, and these are positions that you could say that, you know, again, with the benefit of 2020 vision and hindsight, that we exited the position and then the bond went up in price. But you can see just through the viewpoint and the simple lens of visualization that the net position that we generate in terms of preventing further losses to investors is around $21.5 million in the last 3 years, primarily circulating around the property markets. Okay, so we have this in raw form for those of you that love Excel. Please reach out to client services or myself or Derek or Clayton for those over the ditch in New Zealand, and we're more than happy to provide that raw data to you. But what we want to do is we want to get really, really micro, so that you guys can truly see, because you know, even for me, as the head of distro and chief investment specialist, I didn't know what the answer was, right? I just was very curious to see if Gordon's active management actually paid off, right, within the context of a market that, you know, went through a great purge. So as again, it improves Gordon's skills in what he's done for the fund in the last 3 years, and also more so over the last decade. And sort of moving on from that, Gordon, you know, since we've gotten out of, you know, our property very actively, I mean, where have you then diversified? Because I think for the first time I think almost in the history of the fund, the largest sector in our portfolio is consumer services.
Yeah, consumer services basically are positioned in Macau, right? So if you compare, we have about 12% in Macau. Consumer services, 12 of the 16. That's basically the Macau position. So what's in Macau? Basically one thing is the casino, right? Every major US casino operator and worldwide, they are all in Macau, like MGM, like Sands, like Wynn. Everybody's in Macau. Macau right now is the largest gaming center in the world, surpassing Las Vegas in terms of gaming revenue. Our rationale of owning Macau is basically it plays along well with the China reopening story, right? When China shut down, Macau shut down as well. Nobody went to Macau for fun and pleasure and gambling. So as China reopened, we see a massive inflow of visitors who has been locked down for many months. They want to have some fun and some good time. So everybody from Hong Kong, from China, from everywhere in Asia, they flood to Macau to have some good time. So we position we used to have very little Macau, to be honest. If you compare our fact sheet historically, you can notice we almost owned almost none Macau until we have around more than 10% of Macau. And this theme has played out really well as we diverse ourselves away from China property into other sector and country as well. The other country that we continue to like is Indonesia. For those who are familiar with the foreign exchange market, you can pull up the year to date of all the currency. Not that many currencies actually appreciate against US dollar, and the IDR, the Indonesian rupiah, is one of them, right? So year to date is making having a gain versus the US dollar, and basically supported by their very vibrant economy, and also the commodity prices, right? So within Indonesia, we have position in some of the commodity producer, steel producer, and also a little bit of real estate. And real estate basically also play on the strength of the economy.
Okay. What about energy, utilities, and banks? Can you sort of give us a quick overview of what's the attractiveness of those? Because I remember energy is sort of broadly India as well.
Yeah, energy is broadly India and also Indonesia as well. So Indonesia, the energy issue in Indonesia, these are sort of like commodity, they're raw material producer. So they're classified as energy sector. The energy in India is different. They are renewable space. As people familiar with the Indian market, renewable is a big push from the Indian government, and they have received a lot of support from the government in terms of initiative and concession. So these are the energy sector, and also the utility as well as associated sector with energy. Banks, those are well, some of them are IG, investment grade bond, which see a pretty attractive credit spreads, and also this IG bond will help to stabilize the performance of the portfolio, as well as some of the bank capital from Asian banks as well.
Yeah. Just to sort of break it up, we've had a couple of questions come in, and I'll just put up the fund metrics charts here. Gordon, the first question that came in is, liquidity management appears to be the key issue the market seems to be dealing with now. When you look at your portfolio, can you see many holdings that you feel will need to extend maturity dates or defer coupon payments?
Yeah, good question. For the non-China property, I don't see anything, any issue, any bond will need a maturity extension. For China property, especially, as I mentioned, we use the Great Purge and also the reduction to has eliminated a lot of the issues that we think have potential problem. So I would say, I won't say it's 100% sure, but I think the chance of property developer extending bond, I would say maybe some chance, but not a lot. Yeah.
Yeah. What about?
And even talking about, yeah, sorry. And even talking about Country Garden, if they need to extend, and Country Garden, actually all of our Chinese developer exposure per name is let's set at 1%, right? So if Country Garden needs to extend, we are talking about maybe 0.5% of the portfolio that may need to extend maturity by 2 years.
Yep. Okay. What about China non-property?
We don't see any right now.
Okay. Yep. Okay. The next question is the high running yield to maturity. Okay, sorry. I think it's the high yield to maturity for the portfolio reflects the current negative market sentiment. If this is largely true, what future events or turning points can you see in relation to the market sentiment on the immediate horizon?
I think this is a $1 million question, right?
I agree.
I use the China reopening as an example, right? If you recall, before the government actually announced they're going to reopen, sentiment was really, really bad, right? It was at the low point. I think it's like maybe October last year or something, right? Both the valuation and also investor sentiment was at absolutely low point, right? From all angles, no matter how you look at it, right? But if you recall, Chinese reopening only took less than a week. When the government announced they're going to reopen, we see massive rally, bonds up like 10 point, 20 point, 30 points in less than 1 week, right? So therefore, although we continue to be quite cautious on the Chinese property sector, we are still owning, maybe like a 9%, 10% right now. And you may ask why. The answer is we want to wait for pre-position for that moment when Xi Jinping actually say, go ahead. Okay, I'm going to fund liquidity. Because by the time you realize you want to go in, there will be no bonds to buy. There will be, and even though there's bond for you to buy, you will be paying much higher price at that point, right? So therefore, we are not completely giving up on China property. We will continue to invest our time and effort to monitor the sector and try to control the risk coming from this sector. But nonetheless, we are not giving up in this way because as history shows, if the Chinese government wants to do something, they do it forcefully, and also it happens in really, really short time that investor will basically have no time to pre-position.
Yep. There's a question that's actually for me. So Jonathan, you informed us that our family's got about 4.5 million, and a few years ago we had about 7 million. So what's the difference? Well, yes, the year price has dropped. That's probably the obvious part of it. But there's also been distributions. out of the fund, and those are cash distributions. So that explains both of those movements. We haven't really rebalanced it at all. It's been a long-term holding of the family. So as it's priced at the moment, it's a great investment for us, and that's why we've had significant revised interest from investors around the strategy like this. Because the other thing that I'll note to those on the call today, that the way of how this fund is implemented in portfolios is that it is a non-correlated high income product for your investors. So while 2 months ago, if I just use the Australian context, that investors were saying, well, we're getting 5% on term deposit for 12 months. Well, we're no longer getting 5% for a term deposit. The market is very, very dynamic in nature. But what we've been able to do in the last 13 years in the history of this fund is consistently pay out a 6% coupon per annum, paid on a quarterly basis, at least 6% without fail. And that's reflected through all the research reports, and it is a very highly commendable point through whatever market cycle, whether regardless of Great Purge or the market just going gangbusters because China property was an easier investment thesis than it has been in the last 3 years. We have consistently maintained, as people always say, what was on the cereal box. Okay, have we stayed true to what we're trying to provide investors? And we have. And through active management, we've also been able to save or cut losses in terms of what the market's sort of thrown at us. The last question that I had for Gordon is, I guess one of the increases in exposure for the portfolio has been materially in Indonesia, where we'd largely been, almost zero from sort of 2019 and throughout most of COVID. And now it's sort of the South second largest country exposure. I mean, Gordon, what's the dynamics of Indonesia that draws you into that market and then hence the exposure?
Well, as I mentioned, right, the FX basically tells you a lot of things, right? IDR is only a few currency that has appreciated against the US dollar from year to date. It's basically as a result of the vibrant and strong improving economy of Indonesia. And as well, and the other thing is that we haven't really seen new issuance from Indonesia for years, right? So when people can get hold of the Indonesian bond, they hold on really, really tight, and it's really, really hard to get a good supply of bond from those issuers. So the scarcity value from this country is actually is really, really high. So we like a lot of Indonesia. We like it because of the economy as well as the supportive commodity price, and we also like it because of our demand supply imbalance, where the demand is much more than the supply in this market. So that's why we continue to hold and even add on weakness for issuer from this country.
Outside of the small, just one thing that just came to my mind, outside of the small exposure we have in distressed Chinese property developer bonds, is there anything else in the portfolio, just at an individual level, which you would class as distressed?
No, the way I think of distress is, some people think of distress very differently. Some say they go for dollar price. Some think distress is, those having a credit issue or credit event, right? So if you compare, basically, if you just use these two definitions together to sort of count the so-called quote-unquote distress or the special situation bond, the amount of this position in the Asian income fund, the proportion is actually very, very low. It's in the single digit, right? As I mentioned, the Chinese issuer having a problem right now is because maybe just about 1% or 2% at most, right? Those are on the current valuation. So I think this portfolio will continue to be predominantly a portfolio of performing credit that will enable us to pay the 6% coupon to investor, right? The other way to think of it is that, since I have to service that 6% per year or 1.5% every quarter, right? I cannot really own a lot of these distress or special situation bonds because those bonds don't pay, right? Those bonds are purely, driving for capital appreciation, right? So if you own a lot of those bonds, I simply cannot pay you the 6%. It just, I don't have income, right? So therefore, that's another angle to look at it. Yes, we have some distress or special situation, but it has always been and will be a really small portion of the portfolio. And if some of these distress or special situation if they actually play out at the end, the alpha generation from this position could be huge, right? You are talking about bonds at $10 right now. It could, let's say, even they jump to $15, right? It's 50% return, right? So when we continue to selectively like those kind of play in our portfolio and in all the already partner credit strategy as well.
Yeah. I just thought I might provide just one last bit of context on here before we finish up. We haven't had any other questions come through on this chart about total loss prevented. If I use a rough NAV over the last 3 years of the fund being around 80 million Australian dollars, this equates to about a 25% loss prevention of capital for investors. So that hopefully provides the context, as giving the dollar number doesn't actually provide context if you don't know the size of the fund. So with that, we don't have any other questions that have come in. So I hope that everyone has found this quite helpful. As I said, we're more than happy to provide the raw data to the visual that you see up on the chart at the moment, to give you that micro level of detail. We have gone to a lot of effort to just put together a lot of this detail to give your investment committees, because I see the people that have attended today, they're on investment committees or in your models. So, on a continued basis, we do appreciate your patience with the performance. It is performing and producing the income that we promised since the inception in 2011. We hope that we've armed you with the answers that you provide your clients. But again, feel free to reach out to myself, Derek, Client Services, or Clayton if there are any more questions on the back of that. Sorry, I have one final question that just came in. Okay. Gordon, the question is, in July 2021, the yield was over 9%. I assume this is the cash yield. And the duration was about 2 years. Is the loss primarily coupon defaults or capital losses? I think, okay. I'll have to come back to you, because I don't know if the question is around the yield to maturity or the cash yield. Okay, we'll come back to this person's question, because unless we can clarify that point, we might skip that, because I think we've gone through most of, in a broad way, it's actually neither coupon defaults nor capital losses. It's just mark-to-market movements on the secondary market of the bonds. So it's neither capital losses nor coupon defaults. But we'll clarify the question with the person that's asked it, and we'll get back to them. You'll get a copy of these slides as well, ladies and gentlemen, they're on the call. But with that, I might end today's webinar, and I hope everyone has a great weekend ahead. Thank you very much, everyone, and thank you, Gordon.
Thank you.